You did the right thing. You opened a high-yield savings account, parked your emergency cash inside, and watched the balance tick up every month. That steady growth is happening because the Federal Reserve has kept its target rate hovering steadily between 3.5% and 3.75%. Cash is actually paying you to hold it again. While the national average savings rate is sitting around a dismal 0.38%, you likely did your homework and secured an account offering 4 to 4.5%. This chart shows what that looks like on paper, a solid 4.5% yield. But this ignores a massive hidden drag. Every dollar is fully taxable at your marginal rates. Paying those taxes drops your return significantly, leaving you with your true after-tax yield. There is an alternative. Right now, there are specific short-term bond ETFs operating as cash management tools that are generating yields approaching 6.5%. These specialized tools are designed to layer income-generating strategies on top of safe short-term bonds, rather than competing with your long-term equity portfolio. To evaluate them, you have to understand the complexity ladder. Every extra percentage point of yield you want requires accepting a new layer of market mechanics. Earning more on your idle money requires looking past the headline rate and selecting the exact structure built for your risk tolerance and tax situation. The first step on that ladder is SGOV, the iShares 0 to 3-month Treasury Bond ETF from BlackRock. This is the purest cash equivalent available in an ETF structure. It holds nothing but ultra-short-term U.S. government debt. There is absolutely no corporate credit risk here. This comparison matrix shows how the funds stack up. For SGOV, you are holding U.S. T-bills. It pays a current yield of around 3.75%, and it costs $9 a year on a $10,000 investment. At a glance, the math doesn't seem to work. 3.75% is strictly lower than a 4.5% savings account. But because SGOV holds U.S. Treasuries, the interest it pays out is legally exempt from state and local income taxes. If you live in a place with a 5 to 10% income tax rate, that state tax exemption flips the equation. On a strictly after-tax basis, SGOV can actually deposit more money into your pocket than a fully taxed savings account. Investors know this. Over $47 billion has flowed into SGOV over the past year because it offers extreme liquidity and a deeply stable share price when uncertainty rises. SGOV wins the math equation, specifically if you live in a high-tax state like California or New York, operating as a clean, highly liquid tax shield for your emergency fund. Stepping up one rung on the ladder brings us to CSHI, the NEOS Enhanced Income 1 to 3-month T-bill ETF. The underlying foundation here is identical to SGOV, boring, safe treasury bills, but it introduces a secondary engine to generate cash. The fund managers actively sell put credit spreads on the S&P 500 index, collecting the net option premiums to boost the overall payout. Looking back at our comparison matrix, adding those S&P options pushes CSHI's yield up to roughly 4.69%. But active management costs more, bringing the expense ratio up to 0.38%. There's a different tax advantage at play here. The specific options NEOS uses qualify under IRS rules as Section 1256 contracts. This subjects them to a blended tax rate that favors long-term capital gains over ordinary income. The trade-off for that extra yield and favorable tax treatment is a loss of absolute stability. Because CSHI has exposure to S&P 500 derivatives, the share price will float slightly and react to sudden market volatility. It is also crucial to understand that the yield is a blended payout, representing a combination of interest income and fluctuating option premiums. CSHI is engineered for an optimizer who wants to clear that 4.5% hurdle, enjoys favorable tax treatment, and is comfortable seeing minor daily fluctuations in their cash balance. The top rung of our complexity ladder is OVT, the Overlay Shares Short-Term Bond ETF. This fund shifts the underlying strategy completely. It abandons government debt and instead uses a core holding of investment-grade corporate bonds with maturities of 1 to 5 years. Updating our comparison, layering that same S&P put spread strategy on top of corporate bonds pushes OVT's current yield to an impressive 6.45%. However, it also demands a steep expense ratio of 0.79%. At this tier, you also encounter a highly complex tax mechanic. Recently, OVT's distributions have been legally classified as 100% return of capital. Instead of triggering an immediate tax bill for ordinary income, a return of capital distribution actually reduces your original cost basis in the fund. The cash still hits your wallet, but the taxation is deferred. You are also trading away easy liquidity. OVT is a much smaller fund, managing around $60 million in assets. That leads to wider bid-ask spreads, which will penalize you if you try to move large amounts of money in and out frequently. Taking on corporate credit risk and reduced liquidity means this is not a place for money you might need tomorrow. Securing a yield above 6% demands a strict 6 to 24-month commitment and a willingness to actively manage the cost basis reporting on your tax returns. Cash is only dead money if you ignore it, but even when you put it to work, its primary job is to remain protected while you wait for the right opportunity to deploy it. This decision tree maps out exactly where your money belongs based on your personal constraints. If you need this cash in under 6 months, or you live in a state with zero income tax, keep it simple. Stick to your high-yield savings account and enjoy the easy baseline rate. If you require extreme safety for your emergency fund, but heavy state taxes are chewing up your interest payments, SGOV is your direct tax shield. If you want a higher monthly payout and don't mind watching your share price absorb mild market volatility, CSHI offers an excellent middle ground with favorable tax rules. And if you have a 1 to 2 year time horizon and are willing to navigate complex tax reporting for maximum income, OVT secures the top yield. Keep in mind that none of these yields are locked. They will shift whenever the Federal Reserve adjusts its baseline rates. The true cost of a higher yield is always an increase in complexity. Evaluate your precise liquidity needs and tax geography, then choose the tool that actually puts your idle cash to work.